Welcome back to the deep dive. Today we're tackling something that, well, feels like it should be complicated, investing. But our sources all point towards a surprisingly simple truth.
That's right. The simplest path often turns out to be the wealthiest one. We're going to cut through all the noise, the jargon.
Yeah, all that Wall Street complexity. We're exploring the most straightforward, effective strategy for building long-term financial security. Think. The simple path to index fund investing.
Exactly. That's the core mission for today. We've looked at a lot of material, and it all comes back to this idea of passive management.
Okay, passive management. Define that for us quickly.
Sure. At its heart, it's pretty elegant, actually. It's an investment strategy where you're not trying to pick winners. You just aim to track a broad market index.
Like the S&P 500? Or the whole U.S. stock market?
Precisely. And you do this using things like index funds or ETFs, exchange-traded funds, super simple vehicles.
And our sources suggest the finance industry kind of likes complexity, right? Because complexity means they can charge more.
That seems to be the consensus, yeah. It justifies higher fees, more products.
So for you listening, this deep dive is about simplifying. Our goal is that you walk away understanding why simplicity is like a financial superpower.
And how to spot those sneaky fees that can really eat away at your wealth over time.
Right. And also how you can basically copy the playbook used by some of the greats, like Warren Buffett or Jack Bogle.
It's fascinating because the whole philosophy, it really hinges on just accepting the market average.
Yeah.
Realizing that, trying to outsmart millions of other investors, it usually costs you more than you gain.
Okay. Let's dig into the key concepts, though. The power of simplicity and maybe just as important, patience.
Absolutely.
So the first big thing, and this always gets me, is that the goal here is not to beat the market. You just want to match it. But the data shows this, like plain vanilla strategy consistently beats most of the active funds, the ones whose whole job is to outperform. How does that even work? Why does the tortoise win here?
Yeah, it seems backwards, doesn't it? But the answer is really, well, it's mathematical and it's also behavioral. The numbers are they're stark.
Oh, stark.
Okay, get this. Actively managed funds consistently underperform their passive benchmarks. Over a recent 10-year period, I think it ended mid-2021, only about 1 in 4 active funds actually managed to beat their passive equivalent.
Only 25%. So 3/4 failed to do the one thing they're paid to do.
That's right, 3/4 failed.
Okay, but hang on. If 25% do succeed, shouldn't I try and find one of those winners? Isn't that worth the effort if the payoff's there?
That's the million-dollar question, isn't it? And it leads us straight into something called William Sharpe's zero-sum game theory.
Zero-sum game, like poker.
Kind of. Think about the entire stock market. Before you factor in any costs, the average return of all investors, active and passive combined, has to be the market average.
Okay, that makes sense. Everyone together is the market.
Exactly. So for every dollar an active manager makes above the average, another active manager must have lost $1 relative to the average. It all balances out. Before costs, it's a zero-sum game relative to the market return.
Right. Before costs. So what happens after costs?
Well, that's where the passive approach wins.
Right.
Since active funds have researchers, traders, analysts, they have much higher fees to cover all that.
Okay.
So if the average before fees is just the market return, and active funds charge way more in fees, they're almost mathematically guaranteed, on average, to lag behind the low-cost index fund.
Which brings us to the expense ratio killer.
Bingo. The expense ratio, that ongoing fee.
Let's talk about that fee. It always looks so small, like tiny fractions of a percent. You see 0.2% versus, say, 0.42%. Does that really matter over like 30 years?
Oh, absolutely. It matters immensely. So the expense ratio, ER, is that annual fee you pay the fund company based on how much you have invested.
Right.
Index funds are incredibly cheap now, often under 0.20%. That's like, what, $20 a year for every $10,000 invested? Maybe even less.
Okay, pretty low.
Now compare that to the average stock mutual fund. The asset-weighted average is around 0.42%. So that difference, 0.22%, it seems tiny today.
But it compounds, right? That's what the sources emphasize. Can you give us an example?
Definitely.
Okay.
Let's imagine 2 investors. Both start with, say, $10,000. Both invest $500 a month for 30 years. And let's assume, just for the example, both funds earn a 10% gross return each year before fees.
Okay.
Investor A is in a fund charging 0.42%. Investor B is in an index fund charging 0.20%.
Same investment, same gross return, just different fees.
Exactly. After those 30 years, Investor A, the one paying the higher fee, They end up with tens of thousands of dollars less, tens of thousands.
Wow. Just from that tiny difference.
Yes, because the fee comes out every year before the growth happens. That money doesn't just disappear. You lose all the potential compounding on that money for the rest of the 30 years.
Okay, that really reframes it. It's not just a small fee. It's lost decades of potential growth.
Precisely. And that's why cost is probably the single most important thing you as an investor can actually control. You can't control the market return, but you can control your costs.
And some funds are even free now. I think Fidelity has one.
Yeah, Fidelity launched zero funds, like their large cap index fund, with a 0% expense ratio. Zero. So if you can get the exact same S&P 500 exposure for free, why would you ever pay 0.42% for it? It makes no sense.
Makes no sense. Okay, so controlling costs is huge, but this whole strategy relies on the market actually going up over the long term, right? Here's where it gets really interesting. What does history tell us?
Right. This only works if the underlying market delivers. And thankfully, if you look at the long-term history of something like the S&P 500, assuming you reinvest the dividends, the trend is powerfully positive.
How positive are we talking?
Well, over the last 150 years or so, the annualized return has been around 9.42%.
Wow, 150 years.
And if you look at just the last 100 years, it's even better, about 10.5% per year, annualized.
10.5% per year for a century.
Now, obviously, that wasn't a smooth ride. There were brutal downturns, depressions, wars. But the overall engine of innovation and economic growth, especially in the U.S., has consistently pushed stocks higher over the long haul.
Okay, so if the market's historical average is around 10%, mathematically, anyone who just bought and held should be doing pretty well, right? They should be retiring comfortably. But we know that's often not the case. What's going wrong?
This is the tragic part. It's what some call the silent killer of wealth. Investor behavior.
Our own behavior.
Yes. There was a really eye-opening study, I think JP Morgan did it, that looked at returns over a long period. Major asset classes, like stocks, delivered really strong returns. But the average equity investor, the average person investing in stocks,
what did they get?
they only captured about 2.9% per year.
Wait, 2.9% when the market was doing closer to 10?
Exactly. That's a massive gap. The average person basically left almost 70% of the market's potential return just sitting on the table.
How is that even possible?
Two things, mostly. Panic and greed. Fear and chasing returns.
So when the market crashes,
People panic. They sell low, thinking they're cutting their losses. They can't stomach the drop.
and then when things look good again,
They jump back in, often after the best recovery days have already happened. They buy high because they feel like they're missing out. FOMO. They try to time the market based on headlines or gut feelings.
which never works consistently.
Almost never. And studies show that missing just a handful of the market's best days over decades can absolutely decimate your long-term returns. It could shave off several percentage points per year, easily.
So the core idea of this simple path is that time is your friend, but only if you leave your investments alone to do their thing.
That's the essence of it. Compounding needs uninterrupted time.
So my biggest enemy isn't some Wall Street shark. It's me. It's the person in the mirror.
For most people, yes, absolutely. The simple rule is, if you're buying a broadly diversified stock fund for the long term, you must be prepared to hold it through thick and thin for decades. Endure the volatility.
Okay. Let's talk about that diversification piece. The simple path philosophy often points to a total market fund, like Vanguard's VTI or VTSAX. Why that broad approach instead of maybe trying to pick a winning sector?
Good question. A total market fund, whether it's the ETF like VTI or the mutual fund VTSX, gives you instant ownership of, well, pretty much every publicly traded U.S. company.
Big companies, small companies, everything.
Yeah, large cap, mid cap, small cap. Thousands of companies across all sectors. You own a tiny sliver of the entire U.S. economy.
And the benefit there is,
Diversification reduces risk. Your fortune isn't tied to one company or even one sector doing well. It's tied to the overall health and growth of the U.S. stock market as a whole. If one sector struggles, another might be booming, and you own both.
but I can already hear people thinking, tech stocks have been killing it lately. Why not just buy the QQQ, the NASDAQ Q100 ETF? Those returns look amazing.
And that's the constant temptation, isn't it? It's basically active management creeping back in, even if you're using an index fund like QQQ.
How so?
Because you're making an active bet on technology over other sectors. Yes, QQQ has had a phenomenal run over the last decade or so. But history is full of sectors or styles that were hot for 10 years and then went cold for the next 10.
Like energy stocks or value stocks at different time.
Exactly. The moment you start trying to guess which sector or which factor will outperform next, you add complexity, you add risk, and you reintroduce that behavioral trap of chasing past performance.
So stay broad.
Like Jack Bogle, the founder of Vanguard, said it best, performance comes and goes, but costs go on forever. By sticking with the total market, you guarantee you own whatever sector is doing well without needing to guess, and usually at a lower cost.
Makes sense. And just quickly, for listeners who might wonder, VTI versus VTSAX, they track the same thing, right? What's the practical difference?
Great point. Yeah, they track virtually the identical index, the total U.S. stock market.
Yeah.
VTI is an ETF, an exchange-traded fund. It trades like a stock on an exchange all day long. VTSAX is a traditional mutual fund. You buy or sell shares directly from Vanguard, and the price is only calculated once per day after the market closes.
And accessibility.
ETFs like VTI are often easier for beginners. You can buy just one share through any brokerage, usually commission-free. Mutual funds like VTSAX sometimes have minimum initial investment requirements, like maybe $3,000, so that's changing too. But for most, the ETF is just a bit more straightforward to start with.
Got it. Okay, let's move into some stories or examples. The sources really hammer home that the hard part isn't picking the fund, it's sticking with it. There's a quote I saw, "Time converts to wealth only when left undisturbed. Every interrupted hour is a withdrawal from compounding." That really hits home. That psychological part is huge.
It really is. And we have to be realistic about what staying the course means. To get that long-term, say, 10% average return, you had to hold on during times like 2008.
The global financial crisis.
Yeah, the S&P 500 dropped almost 38.5% that year. Or think back further, 1931, during the Great Depression. The market fell nearly 47% in 1 year.
Ugh, 47%. It's hard to imagine just holding through that.
It's incredibly difficult. Your gut is screaming sell. That kind of panic selling is what locks in losses and causes people to miss the eventual recovery.
So when people sell in a panic, they turn a temporary paper loss into a permanent real loss of money.
Precisely. And they often sit out the recovery because they're too scared to get back in. Holding through those awful periods, that's the price you pay. That's the cost of admission to earn the market's average long-term returns.
But the payoff, if you can do it.
The payoff is immense. We see this in the stories from people who followed this simple path for years, decades. They often achieve what gets called financial independence.
Sometimes called FU money, right?
Yeah, that's the more colloquial term. It's that point where your investments generate enough income to cover your living expenses. You're not dependent on a job anymore.
That gives you incredible freedom.
Total freedom. Freedom to leave a job you hate, start a business, travel, volunteer, change careers, whatever you want. All because they mastered these simple principles. Low costs, broad diversification, and crucially, the discipline to stay invested and ignore the noise.
It really shifts investing from feeling like gambling to feeling like a predictable, albeit slow, path to freedom.
Exactly. Predictable over the long term, volatile over the short term.
Okay, let's boil this down into actionable steps. If someone listening right now is inspired and wants to start on this path, what are the, say, 3 concrete things they should do?
Right, let's make it super practical. Based on everything we've looked at, it's remarkably simple. Step 1, research and identify.
Okay.
You need to find a suitable index fund. Look for ones that track a broad market, like the S&P 500, or ideally, the total stock market. Don't just trust the name. Maybe glance at the fund's prospectus or website to see what it actually holds. Confirm it's broadly diversified.
Makes sense. Check under the hood. What's step 2?
Step 2 is where you save money. Compare and select. Focus like a laser on the expense ratio, the ER.
The fee we talked about earlier.
Exactly. Since many different funds track the exact same index, like the S&P 500, there's no reason to pay more than you absolutely have to. Find the fund with the lowest ER available through your chosen brokerage or fund company. Remember those compounding effects? Tiny differences now mean huge differences later.
Lowest cost wins. Got it. And step 3?
Step 3 is just execute the purchase, do it. If you chose a mutual fund like VTSAX, you'll typically buy directly from the fund company's website, like Vanguard.
Right.
If you chose an ETF like VTI, you'll buy it through an online brokerage account. Fidelity, Schwab, Vanguard Brokerage, Robinhood, whatever you use. And pretty much all major brokerages offer commission-free trading for ETFs now, which is great.
So, research, compare costs, then buy. Pretty straightforward. Now, the discipline part. We keep coming back to that. When is the right time to buy? Should I wait for a dip?
The market timing question again. Discipline is key here. Most experts strongly recommend against trying to time the market. Instead, use dollar cost averaging.
Meaning?
Just invest a fixed amount of money regularly, like every paycheck or every month. Put the same dollar amount in whether the market is up that month or down that month.
Takes the emotion out of it.
Completely. You end up buying more shares when prices are low and fewer shares when prices are high. It enforces discipline and smooths out your purchase price over time. So if you're buying a broad stock index fund for the long haul, measured in decades, the best time to buy is usually whenever you have the money available. Don't wait. Time in the market is much more important than timing the market.
Time in the market, not timing the market.
Okay.
Let's wrap this up.
That's good.
So recapping this deep dive, it really feels like we've stripped away a lot of the unnecessary complexity. This simple path to wealth really seems to boil down to just two core things, doesn't it?
I think so. What are your two?
First, get your structure right. Use low-cost, broadly diversified index funds. Second, get your behavior right. Have the unwavering discipline to just stay invested consistently for the long term. Ignore the noise.
Couldn't have said it better myself. And maybe the final thought, the really provocative takeaway, is this. Remember that gap we talked about? The market historically averages around 10% a year long term.
Right.
But the average investor only gets about 3%. A huge 7% difference. It isn't really about picking the wrong funds. It's mostly about bad timing and emotional reactions, panicking and chasing.
So the biggest gains aren't found in finding some secret high-flying stock.
Nope. For most people, the biggest potential return boost comes from simply conquering their own psychology, mastering the urge to react to the market's gyrations. It really comes down to a choice, patience or panic. The path is simple, but sticking to it is the real challenge.
Patience or panic? That's a powerful way to frame it. This has been incredibly insightful. If you know someone maybe feeling overwhelmed by investing, maybe share this deep dive with them. It could be the simplest, most effective financial advice they ever get.
Hope it helps.
Thanks for tuning in. We'll catch you on the next deep dive.